Good morning, everyone. Thank you for joining today's webinar on the opportunities in the UK property market. My name is Matt Boyd. I'm part of the business development team here in the Sovereign office in Dubai. Joining us today for the webinar, we have Lewis Finn, who is the Global Sales Director for API Global, who will be covering some of the fantastic opportunities right now in the UK real estate market. We also have us joining Hiten Ganatra, who is the Managing Director of Visionary Finance, who will be advising on the current UK mortgage market. And our final speaker this morning will be Stuart Sobey, who is the Managing Director of Sovereign Corporate Trustees Limited in the UK. He'll be taking us through the UK corporate environment and also the advantages of holding a UK company. Once the session has been concluded, there will be a question and answer session, so feel free to ask any questions you may have during the call. And also the call is being recorded, and this will also be sent out to you after the session has been concluded. So I think to begin with, I'll just begin with Lewis, who will be taking through the UK property market.
Lovely, thank you very much for the introduction, Matt. Yeah, so just give everyone a bit of a background. Like Matt mentioned, my name is Lewis Finn. I'm the Global Sales Director for API Global. I think one of the most important things really that we look at, which I'm going to go into more detail on the next couple of slides, is as a UK property investment, we try and make the whole process seamless, sort of hands-off, hassle-free. As an investment, for us, we try and remove all the emotion out of the equation. And yes, I know some people can be quite emotionally attached with, if they're from Manchester, they only want to invest in Manchester, or they want the penthouse floor because it's got the best views, so on and so forth. Ultimately, what we focus on when we conduct our sort of research and analysis is what's giving you the best return on capital. So I'm just going to go through today sort of a bit about who API are, really the concept that we follow when looking at investment opportunities, how we make the process as hands-off and hassle-free for you as an investor, and then just a bit of an update about the UK market and where we're at currently. If you go on to the next slide, please, Matt. Okay, so just a bit about API Global. So we were founded in 2013, so 10-year anniversary this year. Really with the mindset and the goal of how we can enable international investors all across the world access to the UK investment market. Okay, we've now got 9 offices globally, so I'm based in Dubai. In Asia, we've got offices in Hong Kong and Kuala Lumpur, Africa, Nairobi, South Africa, Johannesburg, and Cape Town. Mallorca, we have a satellite office which covers the European region. London is our head office, obviously very important, being a UK property focused company. And Sao Paulo is our latest office that we officially opened at the beginning of April to service our South American clientele and distribution partners down there. Next slide, please, Matt. Okay, so essentially what we offer is an end-to-end solution. Like I said, we want to make the investment hands-off, hassle-free for investors, regardless if you're based in the Middle East, in Africa, in Asia, or in Europe. Okay, so the offices that we have globally are predominantly from a sales perspective. So my team of account managers around the world would sit down with you as an investor to talk through, why the UK, why London, why Manchester, as an example. Whereas the London office is more centered around the main operational roles and functions of the business, which I'm going to go through now. So first of all, we've got a great team on the ground, a team of 10 that specialize in the research and due diligence side of things. So ultimately what they're looking for is new opportunities across the UK, looking at all sorts of fundamentals and macroeconomic factors ranging from capital appreciation and yield trends, supply demand imbalances, where are big corporates relocating to, where is there an investment, both public and private sector, into things such as transport and infrastructure. And really we're seeing a constant demand in an area. Once we've identified sort of an area that we want to focus on, and that's not to say, okay, because at the moment we don't invest in Southampton, let's go and look at Southampton. It could be where within Birmingham or where within in Manchester, as an example, where we do a lot of developments currently. Where's the next value for money? Where's that growth corridor? So if it's not the city centre, is it the cusp of city centres or the zone 2 territories that naturally expand and swell with the investment? That's really what we identify and analyse in that first piece. Now, moving on to sourcing for the projects, there's really 5 developers that we now work with across the UK, regardless if it's Northwest, Northeast, Midlands, or further down south. Throughout the process of the sourcing side of things, we've identified the area. We then look at the deal structures that we can do with these developers. So are we acting purely as their master agent, i.e. their exclusive distribution partner all around the world? Are we investing money into the development alongside the developer to help de-risk? Or are we actually becoming an equity partner? So we would put in the equity and buy the land, the developer would take on the debt to then build up. So that's something that we sort of analyse and assess during the sourcing process. Also within this process, that's where our external solicitors and conveyancing partners would review the due diligence that we've conducted in-house, which is a 121-point checklist. They also have to sign off on any development that we do, as does Hitton and his team, before we actually take that investment to market. Point 3 is then the investment advice. So again, my team of account managers around the world would sit down with you as an investor and really do a full thorough fact find. They would look at sort of what your goals are, what your strategy are. Is it capital appreciation? Is it income today? Are you mostly attached to some areas like some investors are? This is something that we would fully assess and analyse. But again, within that piece, which Stuart's going to touch on later on throughout the presentation, is what's your tax position or liability? Are you better holding an asset in your personal name or setting up a company structure that Stuart and his team can do? Once you've decided on taking unit 1, 2, 3 in Manchester as an example, we then don't just walk away from you as an investor, okay? The whole process we want to make hands-off, hassle-free. So I've then got a team of 6 based between Dubai and London, which is part of the sales progression team, who then hold your hand through every step of the process, post agreeing to purchase the particular unit, okay? Now, the fact that we've got them based between the Middle East and the UK is we can cover the majority of time zones around the world, okay? That sales progression team or that individual within the sales progression team will then introduce you to the conveyancing partners that we've got on board. They'll make sure that from a legal standpoint, the contracts make sense, the I's are dotted and the T's are crossed, so that you can exchange in a timely manner, knowing that you've got full protection of the development and us as a company. Now, we've got 2 different types of developments. We've got completed developments where you can move in, or your tenant can move in tomorrow, you generate an income straight away. Or you've got what's called an off-plan property, where you buy during the construction phase. Now, some investors think that if I'm putting money down now, I don't want to wait 2 years to see a return on my capital, okay? During the construction phase, the benefit of buying off plan for some investors is that you lock in the purchase price here, but over the build time, your value increases. You're actually making a return on your investment immediately. However, you want to see what is going on with that development, how it's progressing over that 12, 18 or 24-month build time. So we've got an in-house marketing team that provide quarterly construction updates in form of drone footage, in real-life pictures, so you can see how that development, if it's a new build, is progressing over that build period. We also then produce monthly newsletters that go to all our investors that cover things like inflation, interest rates at the moment, which I know Hitton will discuss throughout the presentation, where we see hotspots in the UK market at the moment, again looking at the trends that we focus on from a capital appreciation and yield perspective, but also the macroeconomic fundamentals that essentially drive demand and that huge supply imbalance. Now, point 7 is our mortgage support team, again based between our UK office and Dubai, so we hit all time zones. Now, the team that we've got based aren't CMAPs, are not giving the mortgage advice. That's where we rely on someone like Hitton and Visionary Finance to do that work for us. But essentially, the mortgage support team is an add-on to the sales progression team. They would reach out to all our investors 6 months before completion of the project to introduce them to our mortgage broker, i.e. a Hitton and a Visionary Finance. From there, Hitton and his team would then be able to conduct their thorough due diligence and fact find as to where they see the best mortgage product available for your particular circumstances and requirements. Point 8 is then our completions team. So once Hitton and his team have got the mortgage approved and in place, we then look at completing on the property. So making sure that our completion costs are there, i.e. stamp duty, the remaining deposit if applicable, and once the developer has issued a completion notice, that we can complete in sort of a 10 to 14 day turnaround time to ensure that there's no additional fees at the back end and the whole process is smooth. Now, Post completion, we've then got a lettings and management company called Redstone Property Management. Okay, they're part of the API group of companies who again do the full 360 service from a client perspective. They source the tenants, they do referencing on the tenants to make sure they've never missed payments before and they've not been a bad tenant previously. They collect your rent, they pay your rent to any account in the world that you want. They make sure the bills are up to date, they make sure council taxes are up to date, all the way through to the maintenance side of things. So if you had a leak in the boiler or the bathroom, you're not getting a phone call late of an evening or over a weekend. Okay, Redstone are that one point of contact, regardless if you've got one property in Manchester or 3 scattered across the UK in Liverpool, Sheffield and London. Now, for me, point 10 is really the most exciting part. It's what we thrive on as a business, how we get repeat customers and repeat buyers. Portfolio optimization, okay, or portfolio review service as another term. What we're bringing in at the end of Q2 this year, start of Q3, will be a platform whereby all investors can see the amount of units they've got, the purchases they've made. So as an example, you've bought a property for £200,000 in 2018. Your deposit was £150,000, your interest rates at the time were 5%, and your rental income was £1,000 a month. Fast forward to 2023, what are your options? Well, that same property is now worth £300,000. Your rental income is £1,300, and interest rates at the moment are, let's say, 4%. So you've got 3 options. One, we sell the asset, okay, using our Redstone and their partners. You crystallize the gain, you move on, and you invest into something else. Point 2 is a remortgage. So again, Hitton and his team, if you're coming up to the end of your 5-year fixed product, could get you on a lower fixed rate term, so your outgoings are less, your net income is then higher. Or point 3, which has been the most popular choice over the last 12-18 months, is what we call the equity release model. Again, this is something Hitton and Visionary can assist with. Of that £100,000 capital appreciation you've made, can we release sort of 70 to 80% of that, so 70 to 80,000 pounds, to use that as a deposit on an additional property? That way you're essentially doubling your asset net worth without utilising any additional capital from your own bank account. And really that's the major work we've done over the last 12-18 months with existing buyers and our existing investors as to how they can really take control of their retirement and build portfolios utilising the cash they invested 5 years earlier. Matt, next screen, please. Okay, so, oh no, can you just go back one? Okay, so, no, back one again. Technical issues already. So one of the main talking points across, now I think we're going the other way here, Matt. I need to go for the supply demand screen. So one of the main talking points, there we go, one of the main talking points across the UK and in the news recently has been the UK housing targets, okay? Now, for the last 20, 30 years, the UK Housing Association has had a target of bringing 300,000 new properties to market every year, okay? When we've actually looked at the amount of properties that have been brought to market, they've never met that target, okay? However, the demand in the areas that we look at is constantly increasing. We use COVID as a great example. During COVID, there were certain points in time where developers and contractors couldn't get on site. So supply stopped for a period of time. However, the economy and the world continue to move and adapt. I use Amazon, okay, as a great reference point. You know, during COVID, when you couldn't go to the gym, a lot of people would order dumbbells to their house. Why? So they can carry on working out. So the economy, maybe not you, Stuart, I've seen that look, maybe the economy continued to move and adapt. However, supply stopped completely. So when we look at this as a whole and we look at the economy and supply demand, regardless if you're investing into equities, mutual funds, crypto, whatever it may be, if you've got more people trying to buy than sell or trying to rent than what's available, then you will naturally get a growth from a rental and from a price perspective. So just to give you an indication as to how that housing shortfall actually is, you can see on the screen, you know, we've got data dating back to 1989, and you can see the target that has been set and the properties that have been brought to market. So we've never been able to hit that 300,000 new properties coming to market. Okay, so the demand is constantly outstripping the supply. So when we're looking back over the last 20, 30 years, that deficit is only increasing. Now when we're focused on areas where you've got constant investment, constant infrastructure and transport regeneration and development, constant educational institutions and facilities, i.e. colleges and universities, that are bringing more people in, not just locally or nationally, but also internationally. And those students or graduates are staying there post-education. We're constantly seeing a demand outstrip the supply. So when we look at any investment, and again, remove the emotion out of the equation, that's where we're seeing the price growth. Now, it's not just myself or Hitton or Stuart that looks at your Manchesters or your Birminghams and think they look like a great investment opportunity. We actually rely on big corporates, big institutions around the world, like your Jones Lang LaSalle, okay, whose reference we've got on the screen, and what they're looking at over a 5-year period, taking into account all the negative press we've had really over the last 6 to 9 months and being told that the world was coming to an end, is actually the opposite. I think the great thing about property is that it continues to defy all odds. And I use sort of the last 12 months as a great point in that. And we use Russia-Ukraine conflict as an example. In times of uncertainty, when you've got liquid assets, people tend to cash them in and sit on cash because you don't know what's going to happen. So you look at the stock market, you look at the equity market, you look at the crypto market in the last 12 months, typically did that, okay? However, property is an illiquid asset. So you can't go and sell your bedroom, your kitchen, or your conservatory. So you either got to sell the whole property or stay in it. Now, people aren't just going to go and sell their property because there's a conflict going on in the other side of the world. So that naturally creates a demand factor. So when we've got that natural demand, plus everything else going on around the UK that's happening, that's creating the investment and the attraction and the appeal, that's where we're maintaining and seeing the demand increase. So when we look at certain cities across the UK, these are just a select few that JLL have highlighted where they see real growth over the next 5 years. Birmingham, Manchester, Leeds, Liverpool, these are the major cities that we're now focusing on. But again, when you can see a 19 or over 19% return, and it's not a return on your money, it's a return on the capital value, okay? So if you've put £100,000 or you bought £100,000 property and it grows by 19%, then it's worth £119,000. However, you may have only put 25% into that property. So as a return on investment, it's over 90%. And this is something I'm going to go into more over the next couple of slides. Matt, if you can go to the next slide, please. So just to give you an overview about how the UK performed as a whole in the month of March. Again, what we focus on predominantly is Northwest, Midlands and London or surrounding areas of London. That's not to say we're adverse to looking at other areas. Just at the moment, our research and due diligence is telling us that's where the sort of best places to look at from an investment and development at the moment. So you can see the Northwest, the Midlands and London were all in positive growth in the month of March. However, if you look at Scotland as a whole, and one of the reasons why we've not looked at Scotland is because of the fundamentals and macroeconomic factors around it, Scotland actually decreased quite significantly. Okay, so when we're looking at the investment case in the Northwest, West Midlands and London, there are key major cities. We do have other options outside of those areas, but if we hone in on those 3 territories to begin with, that's where we're seeing the real demand and the real growth factors kicking in. Next screen, please, Matt. Okay, and just to sort of finish off on my part, one of the major things we look at when we look at a whole investment and analysis piece is what we call the power of leverage. And again, this is utilizing Hitton and his team at Visionary. For me, you make the best returns in property by borrowing from the bank. Okay, a lot of people have their mindsets of they don't want to take on debt, debt's bad, they want to get to retirement age and be debt free essentially. Okay, however, mortgage debt is a good debt to have because you can utilize the bank's money to generate higher returns than you normally would. So just to give you an example, a £300,000 property, if you buy that outright in cash, okay, regardless if you have a cash or mortgage, the property will always grow by the same amount in value. Okay, so let's say over a 5-year period, it grows by £50,000. Then as a return on your investment, that's a 16.6% return. Okay, we're talking about 3.3% or thereabouts per annum, which for me isn't that attractive or appealing. It's not really going to get me to change away from what I'm investing in currently. However, if we put £100,000 down and we borrow £200,000 from the bank, like I said, the property still grows by the same amount. So if it still grows by £50,000, then the return on your investment, without taking into account rental income, is 50%, because you've only put £100,000 in. So that's why we're then looking at a 10% return per annum. When we add on your net income from a rental perspective, we're getting anywhere from 13, 14% or up to 17, 18%, depending on where you're based and the mortgage criteria and the product that you've taken out. So again, 10% per annum, for me personally, is something that is attractive and appealing and would get me to look at diversifying from my equity portfolio, my stock portfolio, my crypto portfolio. Okay, for us, it's all about the numbers. Yes, it's going to be great to have water views, penthouse floor, whatever it may be. However, if you're never going to live there, it's actually a bit irrelevant. The price that you pay, I'm not saying this is for every development, but you could pay £50,000 more for a unit that's 20 floors higher. However, the rental income may only be £50 a month more. As an investment, the ROI would be less. So for me, it wouldn't be something I'd advise on. We look purely at numbers. If you've put down X, how do we get you to Y? Next slide, please, Matt. And I think that is over to Hittin.
Yes, thank you, Lewis. Thanks for the and very, very insightful presentation there, and hope it was very useful, certainly for me, to see all the numbers there. So thanks for that. Right, so guys, ladies and gentlemen, thanks for joining us today. I'm going to be today talking about the UK mortgage market, and just to obviously follow on from what Lewis has said around the power of leverage and how important that could be to help grow your investment portfolio and your sort of retirement pension fund. So my name is Hittin Ganatra. I'm the Managing Director for Visionary Finance. On to the next slide, please, Matthew. So learn about what we do. We work with foreign investors to support them in securing finance for UK property purchase. So as a firm, we have access to over 70 different lenders. We've arranged over £235 million worth of lending in 2022. And we work with over 15 different lenders that support international buyers in securing funding for their UK purchases. And our vastly experienced team will make sure we find you the best mortgage deal. And as a firm, we are regulated by the UK's Financial Conduct Authority. So in essence, any advice and recommendation that we do give is in accordance with the guidelines stipulated by the UK regulators. So we're truly there to provide you with a professional service and in accordance with the regulatory framework here in the UK. Next slide, please. This is our team, our mortgage advisors. So again, each of these members of staff that we've got in terms of the mortgage advice team is qualified to give you advice in this specific area. It's a very specialist area. So if we look at firms across the UK who give mortgage advice, they're generally specialising in UK-based mortgage finance. But because of our knowledge and growth and our sort of very strong relationship with the likes of API Global, we've cornered the market in terms of knowing which lenders we need to go to find you the best deals, and our mortgage experts here can help support that framework. We've also got a team of administrators that support the mortgage advisors in making sure that your application is managed from start to finish efficiently and that you get updates along the way. So these are our wonderful team members. Next slide, please. So what is the mortgage process? A lot of you have probably not really sort of looked into it in greater detail, but what we do is we take the hassle out in terms of the whole process and the whole journey for you to make sure that we handhold that entire requirement that you have from start to finish, right through to you getting your mortgage offer. So we start off by getting the client introduction. So Lewis and his team, Stuart and his team will essentially introduce you to us, and we'll have the initial consultation with you, which will be a telephone conversation lasting probably about 10 to 15 minutes, just to really get some high level information about what you're looking to achieve, what your financial circumstances are, what your personal requirements are. Once we've had that conversation, that can be done via Teams, Zoom, WhatsApp call, telephone, so whatever method that best suits you. We then give you an indication of what you are likely to get by way of borrowing. So based on circumstances, we could give you a rough idea on the phone to say you'll need about a 25 or 30% deposit. In some instances, you may need 40, 50% deposit. And we'll also give you an idea of rough interest rates that are at the time of your application. So for example, if you're buying something that's immediately ready for completion, we'll be looking at rates now to give you an idea of roughly what rates are looking like. If, for example, you are looking to buy something that's off plan 18 months, 2 years down the line, we'll give you rough ideas on numbers as to what your monthly payments will be. And of course, Lewis and his team will give you an idea of cash flows and what that will look like as well, so that you can then work out what your return on investment is likely to be looking like. And then you can make an informed decision as to whether that's the right investment for you or not. Then once we've done that, and if the property is ready for completion, we will then carry out the client onboarding process, which I'll touch on further on in the slides. But essentially what that means is we need to verify the income that you're telling us. So we'll need verification of your income, your financial commitments, etc. And that's the onboarding email that we send over to you. You then supply all those documentation to us via email. Once we've got that paperwork back from you, we carry out a market research. Now, of course, as I said, with international investors, we work with over 15 different lenders, and our objective is to you, the client, to try and get you the right deal based on the current profile of your circumstances as well as the current market conditions. So we'll research the market and we'll present these options to you. Once these options come over to you, that will give you an indication of how much you're borrowing, your monthly payments, the fees that are going to be associated with that cost of funds. And in this regard as well, we'll have discussions with you around whether you want to be going for a repayment mortgage or an interest-only mortgage. And of course, that is something quite fairly unique to the UK buy-to-let market, whereby a lot of lenders are happy for you to borrow on an interest-only basis, which means that you're clearing the interest on a month-by-month basis, thereby enhancing your monthly cash flow that you're making on the rent. So again, we'll have an informed discussion with you around what your objectives are. Once we've done that and you've given us the green light to proceed, we'll then start the application process. And that's something that we manage ourselves on your behalf. So you're not having to communicate through to the lenders directly. That's something that we're doing on your behalf to make sure that we see that whole application journey, which then takes us on to the stage 7, which is the underwriting process, which is where the lenders will need to see your personal, evidence of your documentation, etc. We facilitate that through our administration team, and the last stage is effectively the mortgage offer being issued. So stages 1 to 8, we would manage that on your behalf, start to finish. Next slide, please. The timeline of the mortgage journey. So this will give you an indication of how long in advance of your property completing that we need to effectively start the application journey. So day 1, you have your initial consultation and an introductory call with one of our mortgage advisors. Within 1 week, you'll have submitted all your required documentation. So that's the onboarding process that we would have gone through, so that we can begin researching of the lending options. Within 2 to 3 days, we'll have the options available. Now, at this stage, we're obviously checking lender criteria, lender policies. So it's not just about rates, but it's making sure that we find the right lender that's got the right lending policy that's suitable to your personal circumstances. And once we've presented that to you, we will finalize the lending options and then move on to the next stage, which will take about 6 to 8 weeks, which is effectively the application process. Now, as I said, we start the application, we do the application on your behalf, and we manage that underwriting process right through to you getting your mortgage offer issued, which will be about 10 to 12 weeks after we've had the initial conversation. Once the mortgage offer has been issued, the legal process can be simplified and finalized, and this can take between 4 to 6 weeks. So Lewis mentioned around the fact that the solicitors recommended that they'll be recommending to you will be the ones that effectively finalize that legal process, so that effectively after 18 weeks of you starting the journey, you'll have the keys to your investment. Next slide, please. So this slide is going to give you a little bit of context about where the UK mortgage market currently sits. So we've seen a big increase in the base rate in the last sort of 6 to 9 months because of the inflationary pressures that are out there. So currently the base rate sits at around 4.25%. Now, what markets are suggesting is that that's topped out. We might see another 0.25% increase in the base rate, which is what some commentators are predicting, but we're looking at the highest it's going to sort of get to at 4.25%. The demand for rental properties, however, has increased substantially. So if we look at what's happened with sort of the supply side of the property, which again Lewis touched on, we've seen a contraction in the rental properties being available in the marketplace, but yet the demand for rents increased because base rates gone up. So people that wanting to buy to live in are not able to do so. So what they're moving to is they're moving to rental properties as a short-term mechanism to be able to wait for the rates to fall. The drop in the pound for international investors has seen more international investors purchase more for their money than in previous months. Obviously, we've seen the pound drop significantly against other basket currencies, so UK has become more of an attractive investment. And what sounds initially like a negative outlook, the UK mortgage market remains stable and reliable for international investors. Let's be mindful of the fact that the UK property market is a very, very mature market. There is a massive shortage of supply of property and an increased demand. So that's making it a very sort of stable place. And of course, we've got a very stable jurisdiction as well. So in that regard, it's a safe place to essentially park your money. And if we look at another thing that was very interesting the other day, which the IMF found, that UK rates will fall in the near future. Now, our inflation rates at the moment are sort of around 10.25%. Now, and that's obviously led to the base rate increasing to where it has. That's led to mortgage rates going up. But what with the IMF are saying is that in the next 12 to 18 months, the base rate will start to fall, which will mean that the mortgage interest rates will start to level out, and therefore the cost of mortgages will actually drop in the near future. So that's another sort of positive news that we can sort of rely upon in the foreseeable future. Next slide, please. Oh, there we go. So to give you an idea, typical questions that we normally get asked is, what are mortgage rates like in the UK right now? So given that the base rate's at 4.25%, if we move on to the next slide, international mortgage rates are starting from 4.99%. So if you look at where the Bank of England's sitting at to where mortgage lenders are charging their interest rates, it's starting from 4.99%. So you're looking at not a massive spread. And if we compare this to how it compares with UK buy-to-let investors, I mean, we get a lot of questions asked around, am I being penalised for the fact that I'm an international investor? No, you're not. The short answer is that the mortgage interest rates for buy-to-let clients based in the UK is also starting from around 4.99%. So you're not being penalised. You are getting rates that are on par with what UK clients are. So it's actually a very good time, especially because you've got the currency play to be able to start looking at investing in UK property. Next slide, please. So I touched on this in one of my earlier slides, as where the sort of the rental demand. An article in The Guardian found that the rental properties have dropped by 9% in the UK in 2022, yet tenant demand has grown by 23%, which was in the same article. And again, the weaker pound is making investment for international buyers cheaper. So in essence, as you can see from this slide, demand's dropping, tenant demand's increasing. So essentially, you've got an influx of sort of demand, which is driving up rents, which is making it a lot more of an attractive investment for international buyers. Next slide, please. So in terms of the onboarding process, a process which I touched on again in my earlier slides, what documents do you need to provide to get yourself mortgage ready? Next slide. So in terms of our onboarding documentation, we'll need the mortgage fact find, the terms of business, and the privacy notice, which again, we'll email that out to you for you to be able to onboard and complete and send back to us. In terms of the mortgage application documents that you require, we'll need identification. So we'll need passports, driving license, any identification cards. We'll need your bank statements to evidence your income. We'll need the proof of deposit. So essentially, if you're borrowing money, say if you're putting down £100,000 deposit, we'll need to evidence that proof of deposit from a money laundering perspective. And then lastly, we'll need the income verification documentation. So we'll need to be able to evidence your income and be able to justify to the lender that yes, you have got the income in the background to be able to support the debt that you're borrowing. Next slide, please. So again, a common question that we do get asked by investors is, how much can I actually borrow? What's the maximum that I can borrow by way of a mortgage? Well, the simple answer is you can borrow up to 75% of the value of the property. Now, This does depend on the profile of you as the individual, as the applicant of the mortgage. So if you've got a good job in a stable organization, in a good jurisdiction around the world, we can get you up to 75% loan to value on your mortgage, which means that you're only having to put down 25% deposit. Whereas if you've got some quirky circumstances where you're self-employed, you've only recently started a new business, etc., and you've not got the income to be able to justify that level of borrowing from a risk profile, then we still can get you lending. But what that may mean is that you're having to put down a larger deposit to be able to get the funding in place. So you may then need to put down a 40, potentially a 50% deposit, but you're still able to borrow. There will still be options available, is the answer. So that effectively, if you are looking at leverage, don't be dissuaded by the fact that your circumstances are slightly unique. Have a conversation with us, and we'll certainly look to try and find you the best deal that's available in the marketplace at the time of your application. Next slide, please. So the next question is, what costs are involved for applying for a mortgage? So there's essentially 4 parts to the costs that are involved, and the next slide will cover that. So we've typically got lender-related costs that include the application fee. So that's typically a fee payable to the lender for making the application. So they'll charge a fee for receiving that application, and that's obviously covered by yourself. There's a valuation fee that will be payable, which is where the lender will instruct the valuation to carry out due diligence on the property that you're purchasing to make sure that the property that you're buying values up. Now, Lewis and his team will appraise the scheme to make sure that essentially you're getting good value for money in terms of the property, but the bank will need to get comfortable around the fact that the valuation, the property does value up to what you're purchasing it at. There will be a product fee that's payable. Now that product fee, depending on what product we go for, a lot of lenders price a number of different products at different rates, and again we'll assess that to make sure that you're getting the right value for money in terms of the product fee. And then the final fee that's payable is the broker fee. Now that's the fee that we charge for effectively making the application on your behalf and seeing it through right through to mortgage offer. So these are the typical costs involved for the mortgage. And then I think we're on to the last slide, if I'm not mistaken. Yep, that's the last slide. So I'm now going to hand over to Stuart, who will then take you on to his presentation. Thanks for listening, guys.
Thanks, Ethan. Good morning from the UK. I'm Stuart Stavey. I'm the Managing Director of Sovereign Corporate Trustee Services, based here. I'm actually based up in Chester, which is northwest. Obviously, Lewis has a fair amount of focus on Manchester as a place to look at properties, and we see that in Liverpool as well. And I've been involved in this business for far too long, and I see the sort of trends in terms of inward investment into the UK, and property remains. I was based in Hong Kong pre-handover, and I saw there was a great desire for property then as a safe investment, but also as creating a good return. So there's still very definite benefits. But since '96, things have changed. That you need to, in terms of the environment here, in terms of inward investment into UK property. So I'm just going to quickly touch on a few points in terms of you need to be aware of in regards to the environment here, and looking at whether you should be looking at maybe a corporate or some sort of legal entity to hold property here in the UK versus doing that individually. Can you go to the next slide, please, Matt? Just a quick, brief introduction to Sovereign for those who don't know us. We're going for about 35 years now, and our core focus is, we deal with both corporate and private clients, but our core focus is we are a company trust and pension administrator based with a global footprint. And as I say, here in the UK, we've got 2 offices, one down in London, which is basically our shop in there, to be blunt, and up here we do company and trust administration. But we are based in, for those listening in from the Middle East, we've got numerous offices throughout the Middle East as well, who will be happy to meet you to discuss any of your requirements in regards to the subject matter today or anything else in that regard. Matt, next slide, please. That's a little bit of repetition, more of a summary. So we'll move. Just conscious of time, so I'll move next to the next slide, please, Matt. And right, so I'm going to briefly touch on the corporate environment. Back when again, just showing my age somewhat, in the good old days, you basically, to hold property here in the UK, you used to put together an offshore company and own it that way. Unfortunately, times move on and life has become a little bit more complex. We still have conversations about people owning properties here through offshore structures. The government here, doesn't really matter which one they are politically, have ridden the coach and horses through those sort of structures and therefore limiting the benefits of owning through offshore structures. There's still some, but I won't go through. I don't think I have to go through the times of the complexities of doing so. But again, some of them are rather more expensive. So in terms of an investment property, they're probably not actually relevant. So people are still therefore saying, well, I don't really want to invest in my own name. I prefer to do this through a corporate structure. We do recommend something that is an option you need to consider, and it's probably a legal entity that you're not unused to. It's similar to the structures you get in the Middle East and elsewhere, but obviously we're talking about here as a limited company. It is still a fairly straightforward legal entity to operate here in the UK. You need a minimum of one director. It's got to be a human being. You can have corporate directors, but at least one individual on the board and a minimum one shareholder. So it's a fairly simple structure to administer. There is, as the points state, there's a minimum amount of company administration that needs to be done to make sure everything's up to date, and certain filings that need to occur. Particularly, most importantly, delivering obviously annual returns to HMRC, which is if those don't know, the tax agency here, and Companies House, which is where your company is registered. And you must maintain a registered office address, which is one of the key functions we provide for legal entities here in the UK. There are various tweaks that can be done to the legal entity, and I will come on to one particular example, which is maybe beneficial. But we are at our core talking about a limited company here, rather than anything else. Matt, next slide, please. I thought this is sort of an overarching slide on a UK. I'm utilising the word holding company, stroke investment company. What a lot of people don't realise is that the UK company can operate as quite a tax efficient vehicle. Now, obviously, when you're talking about property here in the UK, you are effectively taxed at source. The company would be subject to tax on any rental income that is generated here. But it can be used as a very useful structure, not just for owning property, though that is the focus here, obviously. But it's something to be considered that there are tax advantages to utilising a UK company, and we'd be happy to have those conversations down the line. But in regards to this particular subject now, once the profit has been, if you're utilising a UK company to hold UK property, once the relevant tax has been paid, in terms of distributing that profit back to you, there is no further withholding taxes which you would potentially experience with other jurisdictions. So inward investment in the UK, you can basically obviously offset all sorts of costs and expenses in regards to its, in terms of mortgage costs, etc., and then the other sort of maintenance costs against any revenue received from rent. Profit is made, the tax is paid on that, and then dividends can be distributed without further withholding tax. So there are, because you've got to pay tax everywhere, unfortunately, but there are the UK, it's not double taxation because there is no withholding tax on profits on dividends. So there are advantages to utilising the UK company, because again, it allows you rather more flexibility on how you manage the finances of your company to minimise profit. Moving on to the next slide. Next slide. Go on to the next page, Matt. So just going to touch on corporate taxation. Now, I'm not sure why this slide is looking like that, but there we go. All companies and discretionary trusts here in the UK are subject to a 3% surcharge. And the residence of that particular company or trust is irrelevant. Now, I'm mentioning trust because some people have utilised that structure to own properties here. We thoroughly do not recommend against it. Now, to make life a little bit more expensive, unfortunately, what they've done recently is put together a 2% surcharge on all overseas companies acquiring property here in the UK. Now, we'll go, oh, that's great, I'll just utilise a UK company. Unfortunately, if you cannot show that the UK company is resident here in the UK, in other words, if the management control is outside of the UK, the shareholders outside the UK, then there is potential that your UK company will be caught by this additional surcharge. So these taxes need to be taken into account when looking at the property, but also we can run through those with you in terms of, but obviously if it's a UK resident company, it's not an issue, but you do need to look at how, if it is properly resident, otherwise these stamp duty and tax charges will come into play. Furthermore, in terms of there is a horrendous stamp duty land tax of 50%. With properties worth more than £500,000 if that property is not being let out to a third party. In other words, it's let out to a connected party of family members, basically. So be very wary of that side of things. But obviously, just simply, if you're doing this as an investment, you should not be caught by that particular tax. But it's something to be aware of if you're buying a property for, say, a child who's coming to be educated here in the UK. Just be a little wary about that one because you could get caught. Next slide, please, Matt. I'll briefly just skip through this. I think the points are self-explanatory, but basically, the UK company, as I stated, is subject to taxation on its worldwide profits. What we're talking about here, obviously, is the acquisition and rental of property, and then down the line sale of that property, so there will be tax to pay. Obviously, that needs to be reported to revenue and then tax paid accordingly. Coming back to the residency issue, which I touched on earlier, the UK company is deemed resident not only if it's managed controlled here, so it doesn't even have to be incorporated here. Managed controlled here is deemed UK, but if it's incorporated here, then it's deemed to be resident here. And again, I don't think I won't go over the technical details, but just to reiterate, as you can see from those points, there is the UK company, though it is, I would still argue, quite low maintenance in terms of your reporting. Accounts do need to be prepared, annual returns need to be filed, and so we would always suggest that you utilise the services of people like ourselves to ensure that that is all compliant, because otherwise fines come into place, and you've got to be a little bit wary of those side of things. Next slide, please. Right, just again, just quick. There has been recently, there was a budget quite recently, and the Chancellor kindly increased corporation tax up to 25%. Now, this probably, unless Lewis is doing an amazing job for you in getting on your returns, probably will not apply to you if you're owning this through a company. He's probably going to put me straight on this. If you have profits over from 50 of up to 50 grand, £50,000, sorry, you will be subject to a lower rate of 19%, which is where it was previous to the budget. So if basically your rental income is £50,000 plus, and when you're making profit of £50,000 plus, then well, basically I'd say well done, but you're smiling at me, but you would be subject to up from £50,000 up to £250,000 of take a reef. I'm probably guessing that in most circumstances you're not making those profits, I hasten to add, and therefore you'll be subject, the company will be subject to taxation of 19%, which is still a fairly reasonable amount. Again, you're offsetting an awful lot of your costs in terms of finance costs, in terms of maintenance costs against that profit. So that's where we are in terms of the tax environment, corporate tax environment right now. Matt, I think I'll quickly go through this. This is just, as I mentioned before, there are, if you look, if you acquire a property here in your own name, then you are creating an estate here in the UK, and I'll come on to IHT. That creates an inheritance tax planning issue for you. And you might think, well, I'm resident in Dubai, I'm domiciled in, not UK domiciled. Why am I paying inheritance tax? Well, unfortunately, as soon as you buy a fixed asset in the UK, you create an estate here, and that's subject to inheritance tax here. There are various structures out there, and I thought, because of the limited amount of time available, I thought I'd quickly touch on the family investment company. Basically, in a nutshell, family investment company is a limited company, but it has varying different shares, A, B, C shares, with varying rights. And basically what you want is, obviously, if you acquire the property, you ultimately, as time moves on, you want to basically transfer the rights to the income and capital to your next of kin and to the next generation, so that they fall outside your estate. Sorry to be morbid, and so when you pass on, that your estate is minimal here in the UK or below the lifetime threshold, which I'll come on to in a minute about where that sits. So basically, there are structures out there. If you're something, oh my God, I'm buying a property of substantial value over £325,000, which is your lifetime allowance, I'm going to be subject to inheritance tax in the UK. There are things that can be done to restructure the corporate structure to make sure that that there is mitigation in terms of inheritance tax plan. If though you buy your property directly as an individual in your own name, it does therefore makes it much harder to structure matters in regards to mitigating inheritance tax. But first and foremost, you've got to be aware that buying a property here creates an inheritance tax issue potentially, depending on their value, and therefore you need to look at that and work out whether it's worthwhile taking steps to mitigate that, depending on the value of the property. Next slide, please. That is basically quickly a flowchart on showing how we would structure a family investment company, and I think that's probably self-explanatory. But again, I want to move on, so we've got a bit of time at the end of the questions. Matt, next point, next slide. Sorry, next slide again. Right. Okay. There is. Again, you've got to be, there's various rules here in the UK when you're owning property. One, if you are non-resident and you own property here, there is something called the non-resident landlord scheme, which either your letting agent, which Lewis company here would be very much aware of, or the tenant itself would be requiring to withhold 20% of the tax on the rent, and then that is then deemed part of you're also required to make a self-assessment tax return on an annual basis, and any tax withheld by the tenant or the agent is then calculated within that self-assessment and deducted accordingly. But you've got to be aware that you're not going to get your rent gross unless there are applications to allow you to do that, but in most cases they're not, and there is tax to pay here at sources. But again, there is, in terms of with individual, there's some costs you can offset. As I said, mentioned before, with corporate, there's far more flexibility in terms of managing the finances of the company. But again, just be aware of that non-resident landlord scheme, which basically is anybody who's based outside the UK owning property. Obviously, the revenue here, the HMRC here, wants to ensure that they can capture that tax before it leaves the country, and hence the reason for this scheme being in existence. Next slide, please. I mentioned before stamp duty, buy-to-lets, and second-hand stamp duties. That is again very something you need to be aware of. It's it's can obviously a cost. You in fact don't obviously hit on Lewis. We'll take you through those particular taxes in terms of which apply directly to properties when you look to invest. But please be aware of them. Next slide, please. This should not apply to most of you because most of the people who are approaching Lewis will be looking to use their properties to invest and not for not for acquisition for personal use. As Lewis made very clear, this is part of these properties should make part of your investment portfolio. But there is something here called the annual tax envelope dwellings. They don't make life easier here, so ATED, make it a bit easier, which actually applies to properties worth over £500,000. And but if that does not apply, if that property is leased to an unconnected party, which as with Lewis's offering, that should not be the case. So just be aware. We have been people caught by this because they've very nicely bought a property here in the UK for their kids to live in while they've been educated here, and they've been caught by this. Next slide, please. Again, despite the fact that in most assets here in the UK, you're not subject to CGT, capital gains tax. Sorry, if you're not resident here, not through a property. For basic rate taxpayers, pay 18% on UK residential property and higher. Most of you shouldn't be worried about this, the higher additional rate, but I thought I'd mention it anyway, 28%, but you're probably looking at 18%. But again, you need to look at maybe potentially ways of mitigating those, but those are the basic sort of rates of tax you need to be aware of. Again, I'm probably at the end here, Lewis, I've come up with all the positives. There is still an awful lot of things positive about the UK property market. I would be, obviously, but I'm saying I'm sort of coming at the end going, just be aware of these things. But there is, in terms of what is on offer over here, I would thoroughly recommend talking to Lewis about what they've got to offer, because, and also then to us about how best to structure things, because things can be done to mitigate these various taxes. But without going into all the solutions that are out there, because obviously they vary depending on your personal circumstances, please come and talk to us if you're considering investing in UK property. And as a man who's been back in the UK for just over a decade now, there is a lot of money available. There's a lot of demand here for UK property. So it's a very vibrant market. So I without being qualified to advise, I would strongly recommend looking at it and talking to us about how to hold those properties. Next slide, please, Matt. And I touched on the inheritance tax previously. Again, if your estate's worth over £325,000, then there is 40% to be levied. But there are exemptions release available. Again, and we can talk to you about those in detail, but they vary. But again, rule of thumb: if your property is going to be worth £325,000 plus, there's a potential inheritance tax to pay. But I showed you a brief example of how we can mitigate that in terms of structuring the company. Next slide, Matt. I think that should be it from me. And that's where we are around the world. Thank you very much indeed for listening. I do apologise for rushing some of those last points. But I think I'd say what Lewis and said was probably far more interesting to you guys than me banging on about taxes. Corporate structures. But again, I thank you very much indeed for the call. I think we might have some questions on it. I'm not sure.
Yeah, just going through the chat here. Yeah, thank you for everyone joining. I do have a couple questions here. I have one here. I think Hitem might be able to go for. I had a question here saying, Do you need to own an existing property in the UK before I can get a mortgage?
No, is the answer. First time buyer in the UK, have got no sort of UK footprint. We can still get you mortgages. There are lenders out there that we have access to that will still be able to lend you the money. Obviously, the onboarding and the due diligence process will be quite thorough. So you know that we can obviously conduct, but the short answer to the question is no, you don't need to have a UK property or a credit profile in that regard to get a UK mortgage.
Okay, perfect. I also have another one here. It says, what is the maximum amount I can borrow? I know you said 75%, but is there a monetary value that would there be a ceiling for that?
No, typically, and Lewis will probably sort of come in on this, is when you're looking at sort of a UK investment, you want to keep your investment sort of between 150 to sort of £300,000 to £400,000 in order for them to work well. And within those sorts of boundaries, lending is not an issue, and you can get up to 75%. I guess to answer the question sort of directly, a lot of lenders can go up to sort of £750,000, £1 million, £1.5 million. But again, when you go into those sorts of realms, the loan to value tends to drop off, and whether the investment case is worth it is then sort of put into question, which I'm sure Lewis can sort of give some details on. But the limit sort of does go up to in the millions if that was your requirement.
I mean, typically, just on that, from an advice perspective, again, I think we look at removing emotion out of the whole investment element. To spend £1 million on something and maybe borrow 750,000, yes, might be great to live there as your residential property, whether that be central London or wherever it may be. But as an investment, I would challenge it to say it's not a great investment as to what your strategy is. For me, if someone's got £1 million to spend, as part of the advice that we give, it's also about mitigating risks. So rather than putting £1 million into one property, whether that's cash or mortgage, we could split that across 3, 4, 5 different properties, whereby if one didn't rent out but the other 4 did, you're still making money. Whereas, you know, as cliche as it sounds, putting all your eggs in the one basket, if you buy somewhere for £1 million, for whatever reason it didn't rent out, then you're left holding an asset which you're then relying on appreciation as opposed to income.
Okay, perfect. I've also had another question here. Would you recommend interest only or capital repayment? I think that's probably going to be aimed towards Lewis there.
Well, I mean, hitting will probably top and tail this. For me, as when we're looking at investment and we're looking at numbers, interest only by far outweighs a capital repayment mortgage. And again, I think it comes down to the old mindset of I don't want debt, but mortgage finance is a good debt to have. But also the way I look at it is if you can, a lot of people will want to hold an asset for, let's say, 10, 15, 20 years, and potentially after that, either sell the asset or pass it on to their partner or their children or whoever. Let's say you hold the asset for 20 years, okay? And over that 20 years, rather than paying down the equity, you're taking an income every month in form of the interest-only mortgage. When you actually do the comparable of taking the income net of your deductibles over 20 years and then reinvested, that far outweighs paying down the equity on a repayment perspective, because 9 times out of 10, you actually have to put money into the property every month to cover your costs. Whereas if we've got a 20-year period, let's say, where that income's building up with the capital appreciation you get of the asset, that can fund 2, 3, 4 additional properties because you've built up such a pot, and then your return on investment is significantly higher. But again, it comes down to individual circumstances, criteria, what their goal is. 9 times out of 10, the interest-only model works significantly better.
And I think if I sort of just come in there, I mean, if we look at our buy-to-let investors that we deal with, be it domestic buy-to-let investors or international investors, I would say probably 9 in 10 mortgages that we arrange on the buy-to-let basis is done on a interest-only basis. So to give some context, I mean, 65% of the mortgages that we do broker are for buy-to-let investors. So typically we're talking about between 150 and 160 billion pounds worth of lending that we arranged last year was on an interest-only basis. And I think the other thing, the other sort of dynamic that investors think of is if we look at historical house price growth in the UK, prices have pretty much doubled every 17 to 18 years. And if we go back as far as sort of land registry records go, so, you know, as Lewis has suggested, that, you know, if you can split your investment between 2 or 3 different properties and not putting your eggs in one basket, and if you hold that investment for 20 years, if you've, say, invested £1 million, or if you bought £1 million worth of property, say, that in 20 years time will be worth £2 million. You need to only sell one property to be able to pay off the debt on the remaining 2 properties. So again, it's just looking at the overall, you know, taking the emotions out of it and looking at it as hardcore numbers to say, actually, what will this look like and what do I need it to look like when I come to retire? So, you know, the broad space that buy-to-let investors work in is, let's keep monthly costs as low as possible, let's accumulate that, but equally then rely on the capital appreciation. If we look at historical price trends of the UK property market, that you can effectively take advantage of the capital appreciation that's taken over a period of time and use that then to redeem the debt when it comes due.
Perfect, thank you, Hiten. I have another question here, which is, as a non-resident of the UK, am I subject to tax in the UK? Stuart, perhaps you can take that one.
Unfortunately,
another easy one to answer. There you
go. Pretty much depending on. I mean, if you're subject to, let's say you're an individual acquiring property here in the UK. Yep, there's a variety of taxes: stamp duty, capital gains, tax on the on the rental income, and if you're unfortunate, if your property is worth over £325,000, you will fall into inheritance tax net as well. So, yep, unfortunately, you are HMRC here. The tax rules here do grab anybody investing here. But the whole focus of my presentation is that yes, there are taxes here, but there are things you can do to mitigate them. And also protect yourselves individually by potentially looking at the corporate structures to acquire through. But bluntly, yes, you are subject to tax here if you have an asset here.
Okay, and also, what is the relevance of domicile when you're owning a property in the UK?
The relevance of domicile is that as a owning property here actually. Nowadays, as a non-UK domicile, is fairly irrelevant these days, because again, the UK property, if you're a non-UK domicile owning a property here, you will that even though you are non-UK domicile, that falls within your estate. Similarly, if you're a UK domiciled and living in, say, the UAE, you are still subject. You're still subject to UK inheritance tax on your worldwide estate. So, yeah, unfortunately, domicile when it comes to UK property, it catches both non-UK domiciles and domiciles.
Okay, I have another one here, which is, should I set up a company if I'm buying my first property?
Sorry, I can't be exactly. I mean, I would thoroughly recommend talking to us about it and looking at the pluses for doing so. It again depends on the value of that property. It again depends on the sort of expected rental income. But I would strongly recommend looking at a legal entity, because again, it provides more flexibility in mitigating taxation. It can potentially provide mitigation against creating an estate here if properly structured. So, or limiting the exposure to inheritance tax anyway. But so yes, I would talk to us about it, and we can go through it. As I said in the presentation, there are certain taxes, such as stamp duty taxes, that apply to legal entities that you need to take into consideration. But I would strongly recommend looking at it, because there are definite advantages for owning property through a legal entity, such as a UK limited company.
Perfect. Thank you very much. Well, I see you just run over an hour there, so I do have a couple other questions, but I have the email addresses for people, so I'll make sure all those questions are answered for you. Obviously, thank you very much for joining today's session. I hope you found a lot of value in both presentations from Lewis, Hiten, and Stuart as well. As I say, the session has been recorded and it will be sent out to everyone who has attended. And if you have any questions, feel free to reach out to myself, and I'll do my best to get back to you as soon as possible. Thank you very much.
Thanks, everybody.
Thank you.
Thank you, everyone. Thank you.
Bye-bye.